So, hello and welcome again to everybody. This is the second part of our technical analysis series. And today we're going to be discussing corrections and, of course, area patterns. Now, before I begin, we are quite experiencing some stormy weather here. It could be the cause by some of you may not be getting very clear signals. But when you finish this, we will try to recompile much of what we did today and send a clear video to everybody when we produce this quite well. And I hope that you do participate into the Q&A section later on when we have it, just so we can clarify a lot of the points that we come to be able to discuss. I was actually quite pleased to see that our poll shows that many of you seem to be quite disciplined in your trading. Showed you that you rarely chase prices, and or some of you say never, and hats off to you, because that takes a lot of self-constraint, because emotions can really get the best of us in this particular type of environment. And later we shall talk about what those conditions are that may need that type of discipline, because when you're trading systems like this, it's really all about how you carry that discipline forward. And technical analysis is all about learning all the progressive rules that govern it, so that we can come around to exist in an environment of trading that requires this, especially when money is involved. So we'll begin by first trying to give you guys a summary of what we did into our first video, just so it's fresh up in your mind, because we're going to use some of the concepts that we introduced last time. So when we talked about trends and trend lines, we also talked about support and resistance. And we did try to be able to introduce to you that there are points in the market where sometimes markets come to lows like this. And these particular lows are good levels for many people to be able to look for potential buy windows. And if ever the markets climb up to certain high ranges and they experience some selling, we call these areas resistance, because it puts out a lot of shares available and it keeps the market from climbing. And these areas or windows are good for profit taking or for selling. Now, there will be instances, of course, where markets will go up and down along those particular bands. And you just have to be ready that when they do come around to be able to bounce off support, these are good entry periods. And when prices are hitting their head on resistance or coming down from resistance, this also shows you areas that might be good to take those profits. Now, moving forward, we also talked about the ability for support and resistance to change their roles. So if this price movement happens to be able to climb and you see that prices break over resistance, these usually are areas that you also want to see that there may be a potential trend change. And because of this, it could suggest that you probably want to be able to get more aggressive into your position, because it looks like this thing is going to move higher now. So in conditions like this, you might have two more elements to be able to buy into. So the first would be when prices rupture above that resistance or that pattern that you see here. And the second is when the price makes a reaction and falls closer to what used to be a resistance, now acting as support, and this now carrying prices into a new high. So you have three windows of opportunity here. First is the rebound of a support area from a pattern. Second will be when you break over this particular resistance. Hopefully it's not too far away from the base. And better is after a reaction where it creates a base for you to be able to enable a protective stop later on. And this bounce over here might be a perfect time for you to engage a buy as well. If the market goes south and it goes downwards, let's say in a sample like this, you have to understand that we have to keep our safety nets always in place. And so if you see prices rupture below that supportive line, that's your first trigger to be able to command the sell to your position. If you miss this opportunity and there is one more rebound that comes towards what used to be support now acting as resistance, this activates your next condition to be able to sell. So this is what we kind of worked on last session, and I hope that it's been quite ingrained with you, so we can continue to be able to use this moving forward. Now, we also talked about how to draw trend lines into our charts. And trend lines are drawn by connecting either the lows of your graph or the highs of your graph, depending on the trend situation. So if you're looking into an uptrend, then you connect the lows of your graph to be able to determine what your trend line is. If this starts to turn downwards, then you will start connecting your highs as a trend line to be able to follow on the downward movement of the market. So in the picture that we have here, we have an uptrending market. So your main trend line is this blue one that you see here. As you notice, we just connected the lows as much as possible and extended the line towards the future. And again, opportunities to come in would always be a rebound from these areas like here. And what I did is I drew a price channel, or what is known as a trend line parallel. It starts by drawing this first line you see here, getting a duplicate of that and pushing it to the upper boundary of the ranges. And so that at least you now have a guideline to tell you what are areas that might be better for you guys to do some profit taking. So again, the low end of the band telling you better buy areas, the higher end of the band telling you areas where to take some profits. I'm glad to see that many of you don't chase the price. So if you really take that for real, then you should be buying this somewhere down here and not buying it somewhere up here. So you want to be able to make sure that you always are looking towards the best entry point when you're coming into it. Now, if prices rupture support, then remember what we talked about earlier on, there might be a need for you to be able to look into the ability to sell your position just to make sure that you don't get trounced on this, because once this trend changes, then that could be quite a bit of an effect into you. All right. So let's begin our task of motioning ourselves into corrections and area patterns. And it's really very, very important that when we come to understand what this is all about, remember, as trends change, remember, we have to be as sensitive as possible to those changes so we can act sooner. Because in technical analysis, the more that you engage into appropriate timing, the better it will be to be able to enter appropriately and to exit appropriately to make sure that we can maximize our ultimate objective here, which is turn out better profits in the end. So today we'll talk about two things, corrections and the area patterns. Now you might ask, what are corrections? So corrections are simply a pullback in price. And they pull back because the market needs to be able to fix something. We'll talk about that so you can better understand that. And there are different types of corrections, of which we'll outline for you later. Once we engage that, we'll talk about area patterns. Area patterns are more sideways type of corrections. And these particular types of corrections happen because the market needs to rewind itself a little bit more. And so in that context, we'll talk about these patterns. We'll see the different classifications of that. We'll also talk about the different types of patterns that you will see, the names that you probably will have to be able to memorize. And of course, we'll talk about breakouts, breakdowns, and of course, how to use measuring formula when we see such breakouts or breakdown conditions. Okay, so let's start with this as a test case for us. Now, if you look at this chart of Universal Robina Corporation, you will see a very clear upward path into the movement from 2019. However, the path upwards was not a nice, steadfast line. In fact, it showed quite a bit of choppiness, moving up and down several times along that particular swing. And so if you notice all these abilities for prices to be able to move from way up here all the way back down closer to the trend line, these pullbacks in price are called corrections. And they come or they correct because these corrections are there to fix an exaggerated condition with the price. You see in this particular case, it corrected here, 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 and even here. So within a year's time, you're talking about 1, 2, 3, 4, 5, maybe 6, 7 wide corrections that we'd have to be prepared for. It's possible you could just bought this somewhere here and held it through and through. But many times people get shaken out whenever these little pullbacks take place, and because they don't know what to anticipate or to expect during the time that it's pulling back. It's only now in hindsight that you see that the overall trend is still holding. But while that thing is pulling back, you can just imagine what sort of emotions come into your mind when you see these things pulling back, because you might ask yourself, will support hold? How long will this fall? Is this a trend change taking place, or is it just going to be a minor pullback or hiccup? And so a lot of these questions come. And that's why it's really very important we have to understand what are corrections all about? What are they for? And so in essence, a correction comes as a result of prices becoming too extended. So in a case like this, you see very sharp up moves in price here and here. And the conditions that happen there is because the population, who are the investing population, becomes quite excited in buying the stock because they see it moving up. And as more and more people see a price moving up, you get a whole gang of people trying to be able to buy your stock during that period. So it aggravates the upward swing, and it causes that trend to accelerate. But remember, the trend line that you see here, that in blue, this is the way demand is really climbing over time. But if the price is just too far away from that trend line, then something has to give and something has to be adjusted. And that's what we call a correction all about. It allows you to engage some profit taking to put that movement of price back into natural order. And you will understand a bit more of that when I just simply show you this particular arrangement. Okay, so let's start with the basic theme of what the market should try to follow, right? As a rule of thumb, prices must move gradually over time. And we don't mean that prices should streak up overnight, climb up 20, 30, 50% in a single motion. That is abnormal. Normally, it takes time for a stock to climb. And why is that? Well, because remember, the stock price is supposed to be matching whatever the company's performance is doing. It's really all about how well a company is performing, how much earnings is it generating, how much growth is it putting into effect. And if that tells you that it may take time for a company to go from so much earnings to the next level of earnings over time, then you will have a gradual swing up in prices along with that reality. All right? So let's assume that the blue line that you see over here is a typical trend line, and that's the way it should move up gradually over time. So the next statement says any exaggeration of this must be paid for by a correction or an adjustment in time or an adjustment made in price. Now let's try to understand what that means. So if this blue line is the way prices should be climbing, and after people see that prices are climbing and it starts to accelerate way much faster, and it convinces a lot more of the short-term crowd to come buying the stock because of that, you will get an accelerated swing up in price. But remember, this is where the price should be, not up here. And the more you stretch this upwards, it may feel like you're holding two sides of a rubber band and you're trying to stretch it as much as you can. But as you stretch that more and more, you're going to feel greater tension for that to try to withdraw. And it's like gravity into the stock market. And when you get that sense of being too much extended, then that's when the market is going to jump into a need for it to correct. So what will a correction look like? So a correction will look like one of these two, or maybe a combination of these two movements. So there's two ways to fix an extended price. The first way is to make what is known as a consolidation over in time. This is when a stock price moves up and it pauses or it pit stops and it just sidewinds for a while. And it does that over a period of time until it hits the trend line again. This is the way that the market price can start to diffuse the extremely heavy sense of exaggeration that it's managed to do. Now, if it wishes to correct this faster, then instead of going sideways and waiting for the trend line to generate support in due time, the price could actually come all the way back down much more faster and pull itself back down to the trend line faster so that it can fix the need to correct faster and then allow itself to be able to climb back in its normal process thereafter. So this reaction in price is the second type of correction that you will see. So the first is a correction in time, while the second is a correction over in price, because it pulls itself back down in price to satisfy the need to reduce that exaggerated state. And so if you're wondering, why do stock prices go up and down, why can't it just be so much more streamlined? Well, it's because this is it. It's been traded by human beings that cast their emotion in there the whole time. And sometimes they get excited, they buy more. Sometimes they regret it, they unwind some of those positions, and it causes that volatility. But the general trend of the market will prevail. And that trend line that you're looking at, this main trend line, as soon as prices either come back down to it here, or maybe just go sideways to go back here, or maybe even a slight combination of both. In other words, maybe partly sideways, partly in a decline, somewhere in the middle, and it hits the trend line will generate that support that can cast the prices back up all over again. So once the price is nice and fixed, no more need for a correction, then the trend may now resume. So let's have a look at another example over here so that we can get better cast off it. And I will introduce the concept of what an overbought and an oversold condition is. So to demonstrate the typical type of correction, let's have this example we have here of Security Bank. And if we look at the uptrending part that you see over here, let's just have a look. You can see several times along its upward path, you will see a very, very sudden, abrupt, sharp up move taking place. And you will notice that in these advances, that they go up very, very quickly, but almost as quickly they will stop, turn, and try to make that adjustment that we were talking about earlier. So let's discuss this. In an uptrending environment, the tendency for demand is to be able to become big and normal, big and then back to normal. And that's when the market goes up very, very strongly. So if the stock price moves up very, very strongly, what we say too much too soon, we call this situation or condition in the price being overbought. Now, when we say overbought, that means too much buying coming into the stock price, affecting its movement very, very suddenly. So when that happens, you will see a sudden streak up. The market now becomes overbought. Now, let me describe what that situation is like. In an overbought condition, which shows a very sharp upward advance, you are now giving a lot of people who are holding that stock an opportunity to take profit because they're now seeing in that very short term a massive up move in price. And if they have the ability to take that profit, they will. And that act of profit taking will shove that price back down or sideways to contain it from climbing too much. The more you push this higher, the bigger the impact that will be. So I'd like to always remind yourselves, imagine when a stock price is moving along its trend, imagine you have that one rubber band tied into the trend line and the other one tied into the upper end where the prices are. And the more you stretch it upwards, the more extended or overbought it becomes. And that means more gravitational pull on the stock that will allow it to go back down to the trend line. And here's what we were talking about earlier. Do not chase prices this way. If you miss the window, just wait for the next one. And you have to be disciplined enough to be able to do that. So looking at our template here, this is not the right time to buy. This is the right time to buy. This is the wrong time to buy. This is the right time to buy. And keep doing that over and over again. Now, once a trend changes, and you can see here that stock prices turn downwards, you can see now, even into a downward swing, you can see some extendedness. So here we have a downtrend line. Notice I've drawn it by connecting the tops, whereas an uptrend line I connected by drawing it through the lows. And you can see that from the trend line, prices streak down very, very quickly. And this is now what we call an oversold condition. Oversold because you have too many people selling it in perhaps in panic mode, and they've driven the stock price way much lower. Now, in an oversold market, especially one that's turning from an uptrend to a downtrend or a sideways trend and then a downtrend, remember there are a lot of people who are still out there waiting for an opportunity to buy this stock. And when you get these oversold conditions out, you're going to get a lot of people who are waiting on the sidelines saying, wow, it's been some time since that price came back there. I'd like to take some now. And it encourages some bargain hunting. So these oversold swings that fall fast too soon, it allows people to be able to look for an opportunity to bargain hunt. And that bargain hunting activity will create the rally. And so in an oversold condition like this, you see the rebound power comes up to be quite strong in this case, but look at where it rallies to your trend line. And then after that, the stock falls away again. It becomes oversold. But this time, instead of falling much sharper like this, it starts to wind sideways. Okay, and then as it comes closer to your trend line, more pressure is delivered by sellers, and then another decline comes back until it's oversold, and then here comes another rally. So the learning lesson we have in this declining situation is, if you have a position in a downtrend, the best time for you to sell it is after it makes a rally closer to your downtrend line. And don't just come around to chase prices on the downside, because you probably will end up selling at a very lousy price. So that level of discipline has to be inculcated with many of us, so that we have to understand that we only move as it moves out of the range of extension. Okay, so if you are currently buying this stock and you think you want to take some profits here, it might be a good idea for you to do it. But since you are still aligned into an uptrend, if you're going to do any profit taking in an uptrend, you should probably maybe look at maybe 10 to maybe 30 or even 40% of your position. The rest you should keep because the uptrend remains. It's only when the trend changes or your trend line breaks that you should be unloading a fair amount of your position. In a typical correction or slight correction without a trend change, you should be holding a bulk of your positions in there while the trend remains. And you only take some profits when it becomes too extended. Now, I'd like to demonstrate for you the different types of corrections that you see and that we talked about earlier. This is an example of a correction in price because it actually withdraws the price from the high band all the way to your trend line. Just like this, it moved from way up here to this decline. Here in this case, the correction is a correction in the opposite manner because instead of correcting going down, this is now a downtrend. So your main trend is down. A correction in a downtrend means it has to rally upwards because it's too extendedly into a decline. A rally is that correction that fixes that exaggeration in the decline, and this alleviates that particular pressure. Okay? Now, in a correction over in time, you will notice that the correction in time it could be a combination of a little bit of price movement downwards, but generally you will see it sidewind, up, down, up, down, up, down. And that winding phase allows the stock to be able to regain energy within that condition. Okay, here you can see the same thing. Prices had fallen down, maybe not as sharp as this, but after a while it rebounded, fell down, rebounded, and fell down, and it wound up before attempting to be able to take in a lot of supply and cast the next decline right after that. So sideways corrections are corrections over in time, whereas very deep or sharp moving corrections are corrections made in price. Okay, so what happens when we see a correction take in? When a correction is activated, you as a trader, you have to get ready with what is to follow. Because when a correction is announced, that means that a wider pullback may be coming in. And so your job is to figure out how far down could this go. Because you might sense that you might ask yourself, if it's not going to come down too much, you might even hold your position. But if the potential for this to come down is quite significant or meaningful enough for you to sell first and buy back later, then you do that. So let's have a look at this Ayala Land chart here. So you can clearly see that this was an upward move, eventually turning a little sideways, and then eventually turning downwards. So first things first, let's just draw our typical trend lines. We have a longer term trend line here, and we have a shorter term trend line drawn into the first one here. Okay, as the first trend line breaks, this is the first sign you have that support has been violated. After the violation of that support, it tells you, oops, this correction is intending to do something wider than normal. Because if it was just an ordinary correction, this should have just gone back down here and then rebounded right away. But given that this trend line has broken, that tells you that that trend is finished and that something wider is coming in terms of a corrective tug. So now the question we're going to ask ourselves is, where should the price fall to? If you don't know how to identify your support lines yet, you can use your trend lines to some use there. So if this trend line fails, you will look into the next trend line to be able to offer the next levels of support. But there's something else that you can do. If you remember in our previous exercise in understanding support and resistance, we said that support areas are areas where you would come from the base of patterns, such as this. And we also talked about the reverse of our roles. An area that used to be resistance, like this, after it's broken, changes its role and becomes support. So by doing that, I can now level out areas that can potentially be my next support for prices to see where these things could shelter itself when it's making a correction. For example, after a support break like this, I will now mark out this area here. Why? Here I could see there was a previous low before a rebound took place. And it also happened to be the area where there used to be a resistance where prices broke free from. And so this used to be resistance, now acting as support. And thus this area here should act as the first level of support for the stock. Now, if this breaks, where do we look next? So now we go down to the next level of support and see there was a previous low over here. So this area here, or let's mark it as S2, is your next level of support. And if you notice, this is roundabouts where prices fell to next. Now we ask again, just in case this breaks, where would prices go back to? So let's now look back here. Here you can notice there was a previous area of resistance in this zone. Let's just mark that out. And prices broke up above from it. And so what used to be resistance is now acting as support. We will mark that now as S3. And this support level 3 is where prices should look at in case this first level, next level of support is broken. You will notice on the right side here, this happens to be where prices happen to stop as well. And again, we'll ask ourselves, just in case this support level breaks, where's the next one? So let's draw that for you. The previous low in the pattern following it downwards will be at about roughly this line. This is what we call our support level 4. And so if you just see what I'm doing, I can now mark out areas that potentially can be areas of next support. And so just in case these levels of support break, I can now get a sense of how far down the stock price can still go. And so now, again, you're given that advantage of range so that you can project what you're doing. If, for example, this is broken here, and you know that the next level is somewhere down here, and that's a good maybe 2 pesos and 50 cents away, you can now make a judgment call whether to sell or not to sell that stock depending on the range that it will impact on you. And that's why understanding where these levels of support can be. So in a correction, you have to get a sense of element of where these zones are so that you can make such estimates and you can factor it into your trade accordingly. Now, another way of doing that, a little bit more complicated, is going through what is known as a Fibonacci retracement. I don't normally will teach this in an introductory course, but I want to be able to present to you how deep you can go when you study technical analysis. Now, the Fibonacci retracement system, I'll explain to you how it came about. It was actually invented by, or it actually came from a mathematician who lived in the 1200s whose name was Leonardo Pisano, who was later more popular known as Leonardo Fibonacci. Now, this mathematician loved to review relationships in nature, and he loved working at numbers. And in his spare time, he would craft numbers and look at relationships between how animals would give birth to one another and how many there would be. And he would study the waves of the ocean and see how high and low the waters would be, and he would try to calculate that. But as much as I don't know how exciting that could be then, and he came up with something called the Fibonacci series of numbers. You may have encountered this perhaps in your college entrance test. The Fibonacci series of numbers looks like this: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, and 55, and so forth and so on. But if you want to know how the series of numbers were calculated, all you simply do is get the first number and add it to the number next to it. So 0 plus 1, 1. 1 plus 1, 2. 1 plus 2, 3. 2 plus 3, 5. You get the picture over and over again. Now, the nice thing about that is not so much of the number itself, but in how percentage degree difference is one number to the next one. And for example, if I were to continue this series, 21, 34, 55, 89, 144, and 33, you will note that every time it incrementally goes higher, it does so by 61.8%. Yes, you might say, big deal. But let's just keep this number first in view so you can see why this number becomes very important later on. And if I were to go downwards, it would be a retraction of 38.2%. Add these two numbers and you have 100%. So one of the other things that the study of the Fibonacci ratio came to be able to unearth was very much highlighted when people started to study the shell of a snail and how this geometric spiral would spin out from one to another. Now, this particular type of spiral, becomes very important in the study of Fibonacci, because the spin out rate of this as the shell becomes bigger was spinning out by a ratio of 61.8%, following the same spiraling element or this number series that you see here. In fact, when you study the movements of the way petals of flowers actually come out, you will notice that lots of flowers out there, they follow this same number series. For example, if you were to count the number of petals in this flower, you will see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, and 13 happens to be a Fibonacci series number. In fact, if you were to plant certain types of plants in the ground, and as a seedling they break out and they start to be able to germinate and become a taller plant, you will notice that the branches or the stems into branches that is built into that also follows a geometric series. So it goes from a single branch, spreads out into two, and then spreads out into 1, 2, 3, and then goes 1, 2, 3, 4, 5, and then 8, and then you go up to 13. And so you might be wondering, what happened to the number 4? Well, it skipped that because a number 4 in nature is not very common. Yes, it happens once in a while, but it happens as an aberration. This is the reason why sometimes when people tell you if you find a 4-leaf clover, it is a lucky clover. And the reason is because you normally see 3 leaves or maybe even 5 leaves in a clover and not 4. And so again, we see these presents. The spiraling universe outside also expands at a ratio of 61.8%. And so technical analysts try to be able to borrow this particular theorem. And they wanted to see if they could apply this into the movement or the expansion and contraction of stocks. So what they did is they studied the movements of lots of companies that moved from, let's say, a trend move from A all the way up to B. And in this particular swing, we wanted to know whether the pullbacks in this particular price are showing quite a bit degree of substance in terms of a reaction. And using the numbers that we have here, 38.2, 61.8%, and the middle ground, which is 50%, and we will draw that as a potential reaction area for this particular study. So the 38.2 is this, the 61.8% is this, and we just get the halfway point of a regular pullback would be 50%. Now, this is the way this should work. Ideally, the way the concept is built is, if a stock price becomes exaggerated from going from A to B, a pullback that goes to somewhere in between 38.2 to 61.8% should attempt to finalize the need of that stock to correct. And then after hitting that zone, it should allow the stock price to be able to rebound thereafter. So here's an example. So if the stock price makes a correction and it only falls to the 38.2% zone, when you say 38.2%, that means it corrected 38.2% of this entire upswing. So when you say 50%, it corrected half the value. And 61.8% is roughly almost this range that you see down here. Now, in essence, if the correction is limited only to a 38.2%, and then you see the stock starts recovering already, that means the stock is underlyingly very strong. And then more likely, this stock has a good chance of going into a new high. Now, if the correction brings it to generate a 50% correction, that means it's lost half of its value into a correction. Yes, it might be able to rally, but it might have to generate a pattern or maybe even retest this low again before allowing it to continue moving up. And not right away, it will climb up above this point B. Now, if the stock price goes all the way back down to S3 or support number 3, and it hits a 61.8% correction, that means, yes, it managed to fulfill the corrective need, but it dropped down too much. A lot of people who probably bought here are starting to take a little bit of a loss. And because of that, they're probably selling their positions. And also because of that, a rally over here might be limited in terms of its ability to climb. And so normally after this normally will test this low again, or may just consolidate for a while before just climbing up. But normally it's these first ones here that are still very strong. And normally these ones, you probably get it back to the previous high, maybe even make a new high before the next correction is carried out. And I'll show you a demonstration of that. So here's an example of Bank of the Philippine Islands some time ago. And I wanted to show you a typical example of a very strong upward moving path like you see here. Now, along with that, I drew a trend line, which you see has broken here. Now, the reason I'm drawing a trend line along with this is because a trend line becomes very important here, because if you draw the trend line and you know where the trend line breaks, you will know when and how to draw a Fibonacci tool, when to begin it and when to end it. So for example, in what I've done here, as a general rule, if an uptrend line has not been violated, you cannot force in a Fibonacci retracement into a stop. It can only do that after a trend line is broken. Then you start measuring downwards. If your trend line is secure, then your trend line should be acting as support and not these measurements that you would see on a Fibonacci line. So let's just go to this particular element because there was a trend line break here. And because of that, we needed to forecast how far down can this stop go. And by using the Fibonacci system, we started by drawing from the base of the trend move to the topmost area of a trend move. And you will see as we projected it down, here's a 38.2, 50%, and 61.8% zone. In this case, BPI corrected to the 50% zone. And after that, it rallied, tried again, second time, and then eventually it rallied already after that. So this is still okay. But if this pullback went all the way back down to the 61.8%, the rally you see here is not going to be as strong. It will take more time for that to be able to recoup back to where it's come from. Now, in a decline, you can also use the Fibonacci tool to be able to do this. Now, here we have a downtrending situation. I've drawn a downtrend line by connecting this top to this top and all the way to this top here, and you will see that prices ruptured above that area there. So now this is telling you that the stock from a downtrend is trying to be able to generate a wider rally. In a wider rally, we will now use the Fibonacci tool to try to be able to estimate how far upwards would this rally go to. So given the context that the downtrend began here, we will use this as our base, start here, extend it downwards to the low. I normally tend to ignore this daily wicks of prices because they're not very heavy impact of support. It could also be that perhaps only a small amount of shares were traded there. So I usually like using the bodies of the candles to express the high and low ranges of a stock. So given that, projecting upwards, now you would see the 38.2, 50%, and 61.8%. Mind you, that you can see the numbers have turned themselves around. In an uptrend, you see the 38.2 is on the upper boundary and the 61.8% is on the lower bound. But since you turned the trend upside down, and now the rally is what we're trying to figure out, a 38.2% rally should come first and the 61.8% rally comes in last. In this case, ICTSI did make a rally, and it only rallied up to the 38.2% zone. So if I were to look at this, the rally was not that strong because it did not manage to be able to recoup back to the 50% nor the 61.8%. And because of that, that means this stands good chance that this could come and retest that low. And so in this effect, I would take to be able to sell a portion of whatever position I still have here because I can feel the resistance there in preparation that this might come back down and I want to get a new buying opportunity at a lower price. And this is how we come around to use the Fibonacci retracement system to help you make an assessment of how far a stock could go, especially into a recovery or a correction point. So again, please remember the trend lines become very useful here. Because remember, if a trend line is not broken, you do not use a Fibonacci tool to try to see where prices will go. The trend line should be the one to tell you where that is. It's only when a trend line breaks that you use a Fibonacci tool. Now, let's try to demonstrate to you how to be able to call that tool out in our charting program and how to actually use it along a graph like we see here in the case of Jollibee. All right, so let me walk you through this. So we'll start with Jollibee here. And what we're looking at is we're looking at this uptrend, which began sometime in April, all the way back up here, and eventually went sideways into a correction before going back up. So let's try to make an application here. So first, we will draw a trend line. All right, just it there. Now, you can see that every time prices rebounds from that trend line, it's acting as support, but there was a time that it broke it, and that's where a wider correction took place. So we'll use this Fibonacci tool you see here. And again, you will start on the bottom range of the trend and connect it to the topmost range of the trend. And you will see here on the right, you can clearly see that it's marked off the Fibonacci retracement areas automatically. And you will see where prices happen to have just stopped. They stopped at the 50% zone before moving higher. In fact, it tested that 2 times before attempting to move higher. And so this is an example of how we can try to use that to our advantage. Let's look at the downtrend of Ayala Land. Let's draw first a trend line so you know how to draw a Fibonacci tool. First, I will draw the longer term trend line. Notice there's been no trend break in that one. I'll draw another one. There's no trend break in this one either. Let's draw the third. All right. And in this one, there was a trend break here. And so this is the trend involvement that I will begin to draw my Fibonacci tool retracement. I will start from the top of the trend, and I will draw it to, again, where the body is. I don't like using those wicks, those tiny wicks for a single day. I don't like using this. And so again, it automatically draws at 38.50 and 61.8%. In this case, the maximum rally went closer to the 50%, but generally stayed in the 38.2% zone. So this rally was just so, not so weak, but not so strong. Let's look at one more, Globe Telecom. Very sharp up move. Let's draw this trend line here. And you can clearly see there was a correction after the trend line was broken. We'll do the Fibonacci line now. All right. And now you will see that the correction went to the 38.2% zone. And that means the correction was very slight. In fact, that's the reason why Globe managed to be able to recover quite well recently. And so you can use the Fibonacci tool to make a prediction as to how far the stock could go, so that you're prepared to understand that if there's support here, I could probably enter the stock in this area if it doesn't break. And if it breaks the 38.2 after you bought it, you can use it as a stop loss point, because then after that, it will go down to the 50%. And if that's broken, it will go down to the 61.8%. More likely, if it goes even below the 61.8%, the reason for that would be because a trend change had already taken place. So try to practice using your Fibonacci retracement system. It can help you make an assessment as to where next support levels can be, or in a downtrend, where the maximum rally points can be. And that can prove to be very timely for you to be able to take advantage of your entries and exits as well. Now let's talk about area patterns and consolidations. So the first type of correction we talked about was a correction in price. And that's why we either looked at support levels or using a Fibonacci to make that assessment. Now we're going to talk about the sidewinding type of corrections. And these are called the area patterns. So area patterns, or consolidations, another way to call them, are depicted by sideways moving markets. Okay, now they could be irregularly shaped, or they could be very jagged, but ideally they are moving sideways in a sense. Prices pause in this pattern because they need time to be able to fix that extendedness that the prices had shown earlier. So if a stock price attempts to move up, for example, let's look at this. So if a stock price like this moves up very, very quickly, it stops and it pit stops and it generates a sideways motion in price, just like what you see here. And what it does in there is it gives avenue for some people to take some profits. It also gives the other end, which is people waiting to buy, an opportunity to buy that stock. Instead of having to chase it, at least it's winding up. And that should be able to give them a fair amount of comfort, because they can now see what their low sides are, rather than buying somewhere here and knowing that your support is way down here. So what happens now is the stock starts to sidewind, and in there it's regaining some energy. Whether that's energy to push it up or to push it down, we'll find out later on. But in this particular case, it happened to be on an upward move. So what happens here is we're waiting for this consolidation to finish, or this area pattern to finish. You have two options while you're doing that. You could range trade this pattern if it's big enough. So for example, you'd be buying on the low side, selling on the upside, buying on the low side, selling on the upside. Or if the range is too small, then you have no choice but to just simply wait for this to break out. A breakout is called a pushover resistance, like this in a pattern. And in a breakout condition, that tells you that the trend from a sideways motioning situation is now back into an uptrend. And you can now start buying the stock again because the uptrend has come back into place. Now, Let's look at an opposite condition. Let's say your stock price was falling, it becomes oversold, and now it makes a recovery and parks itself for a while. And you can see a much more longer consolidation sideways here. And it moves from support and resistance inside that set band. Again, if the range is big enough, you could buy towards support and you could take profits closer to resistance. But normally, if I see that the main trend is down, I usually don't do that. I will only do the range trading if I see that it's generally on an upward path, so that just in case the prices do break out, it provides an avenue for me to have that extra punch into the profitability side. Because here, if you call it wrong, you could walk out with a bleedy nose because you're actually trying to buy this into a general downtrending situation. Now, once the support into a pattern like this is broken, or a consolidation break like this takes place in support, we call this breach a breakdown condition. Now, a breakdown condition means a sideways market has now turned back downwards and that an avalanche of selling is getting ready to take place. And normally this is the reason that in a breakdown condition, we are really looking to sell our shares to protect whatever profit we still have or the value of what we have inside our position. In a breakout condition, we're looking this for potential buy because it tells us that a new uptrend is coming back, and we want to be able to get a bit more aggressive into this position because it tells us that since a new uptrend has been reignited, that we may be able to make more money as the stock continues to move higher. So again, breakout should be able to lead to a consequent buy, while a breakdown should lead to a consequent sell. Now, I want to also tell you about volume because, as I told you in our last episode, that volume along with price are the way we will be looking at prices. Now, volume gives a third dimension into price. Now, normally when activity like this is high, you'll get a lot of people trading. Volume levels could be quite decent, if not high. But when consolidations like this begin, the tendency for volume is start to drown itself down or to narrow itself because less and less people become interested in a stock price that's not moving or it's sideways spin because it's very hard for them to make money. But that also gives us a clue that if that volume levels becomes too dry, it could also tell me that the potential move may be coming because there's no more shares to be sold and that more impact on the trend move may come up very, very soon. So it's something that we want to come and look at. Also, in a breakout condition like this, volume levels should start to improve or enlarge. And that should be testament to you that more following is coming to the stock. And that's quite helpful because at least it tells you that demand is following along with you. And they will be your backers to keep that propelled into an upside. Or if that happens to be in a downward market, that tells you more volume coming in and more volume pushing the stock price down. And so that should make the trend more lasting. But if the volumes are very fickle or very narrow in a trend move, then you should judge that there could be an end to this coming soon. And that's why we look at volume along with the movement of price charts. All right, let's go back into those area patterns. Now, when we talk about these other area patterns, it's important to be able to take two things off these particular patterns. One is the shape, second is the size. Now, when we talk about a shape of an area pattern, I am talking about the geometrical shape of what that pattern looks like. So let's have a look at this sample right here. Here, we have a price swing going up and down, up and down, up and down. You notice that the tops tend to share the same general zone, and the bottoms also do the same. And so we have a flattish bottom with a flattish top. And let's just look at that in terms of supply and demand. Resistance is an area of supply. It's an area where there's a lot of shares that are being unloaded by people who might think that it's a good price to sell at. When we talk about support, we're talking about an area of demand, an area where there's supposed to be a heavy amount of concentrated buying taking place. And here, a lot of people want to buy because they feel maybe the price is decent, or because maybe they've seen a low there before, they might think it might happen again. And so as these support and resistance areas test and prove themselves more and more over time, the stronger they become. Now, look at the shape of this. You can see a flat bottom and you can see a flat top. Let me contrast that with this next sample you see here. Here's a different type of area pattern. The tops are the same, just as this. They're also flat. But if you were to look at the bottom range, as you can see that this is not a flat bottom anymore. You can see that the lowest one's here, and the next low has made a higher low. And you can see by connecting these two together, I have a demand line or a support line that's climbing. Or if you'd like, a support line that's getting more intense or stronger as compared to your supply line, which is only flat, or your resistance line, which is flat. Now let's talk about what that means by looking at the shape. So if I were to describe to you how is support or demand taking place here in the first example, that means the people who want to buy this only want to buy it at that price. They're not willing to raise their price to buy this stock. Only if the price comes back down to this price will they buy. So you can see that that support or demand is relatively neutral. The seller is the same. So the resistance or supply situation with the seller tells you the seller only wants to sell at this price, and he's not willing or she's not willing to sell the price lower. And because of that, you have a relatively neutral supply line or neutral ability for the seller to go out. Now, why do I want to call it that way? Was it neutral or is it aggressive? The reason is this will give you a good sense of how strong the movements of the market are showing you. Is the market force in favor of demand, or is the market force in favor of supply? In this case, it's neither one of the two, because your supplier resistance is just flat and so is your support. And since these two don't want to push prices against each other, then what's going to happen here is a battle of attrition. Whoever loses their shares or whoever loses the amount of money to buy, eventually they will win the war, right? Then that's how you will wait for this to happen. But in the second situation here, you look at demand. Demand is slowly picking itself up. That means the buyer here wants to buy higher and higher, maybe because he has a much more firm need to accumulate those shares. Whereas the seller standing here is only willing to sell it at that price. Eventually, the buyer will reach over to where that seller is, and he will now contend with them and say, if you really want to sell it there, give it to me. And so now here you have the aggressor, the buyer, as compared to a neutral seller. If you were to look at this in that simple sense, you could probably say that since demand is rising faster, more intently with greater force, then there's greater chances that once this meets together, that push prices way up here. That's why 85% of the time, if you see a pattern like this pattern is called an ascending triangle, that 85% of the time, this will break out topside and allow this uptrend to continue. Whereas in a case like this, 50% of the time it will go up, 50% of the time it will go down. We will give it a little bias depending on what the previous trend was, though. So for example, if this goes into a sideways move and the prior trend was up, we'll give it a slightly bigger chance that the potential for this is to continue going up, because we'd like to give that chance into what trends are. In this case, it's very clear that the upward movement will break over this over in due time. So you should be leaning toward the potential for this to climb. Now let's talk about the height and length of an area pattern. Now the vertical distance from the low to the upper end of an area pattern is also something we will account for later. We call this the height of the pattern. And when you draw one, you should always drawing upon the highest point, not the narrowest point like it would be over here. And we'll do this because we will try to measure what an up move or down move will be later, depending on this vertical size that you have. Now, why do we want to see the horizontal length? The horizontal length of a pattern will give you a sense of how long was the winding phase taking place. Imagine you have a wind-up toy with you, and you're winding up the key on that. And as you wind it and wind it and wind it even more, in this case, it consolidates even more. It generates more power and more explosion power later on when it comes out of that area pattern later. So the longer the area pattern, the greater the consequence of that push that will come out later. Also, the wider, the more vertical space you have in an area pattern, the more substance you can carry a breakout or breakdown condition from that pattern. And we'll study those measuring formulas later. To give you an example of what area patterns would look like, we showed you what an ascending triangle looked like a while ago. So let's just quickly go through them. You can study many of this on your own. Many of you, if you have time, please go to a website called stockcharts.com and click on the link called Chart School and look for the area pattern category there. It'll give you good review materials on how to be able to study each of the every one patterns that you have here. I can only cover so much today. In general, what we're going to do is we're going to be looking for consolidation or sidewinding movements in price. We will draw our two lines on them, and then we will describe to you what those lines are depending on what the positioning of these two lines look like. Also, it can help you make an assessment whether does this have greater chances of going up or down. And going through this, let's review on what the potential for each one is. So beginning with the ascending triangle. So the ascending triangle has a flat top and has a rising base. And so you can see eventually over in time, if this were to just continue, these two lines will eventually meet each other. And since, like I told you earlier, this describes a seller who is neutral and describes a buyer who is intent to buy, an aggressive buyer. And so an aggressive buyer facing a neutral seller will show you greater chances of this going up. If this were to break out of that pattern, that means it were to break resistance, it will go up by a minimum distance of this vertical size that you see here. And so the measuring formula would be to go all the way back up here as a target. All right, and your entry point should be as soon as prices attempt to break out. Let's look at the next pattern. This is a descending triangle. This is opposite to an ascending one. In a descending triangle, you will notice that the demand line or your support line is flat. That means your buyer is neutral. Your seller is now aggressive. He is the one willing to sell prices down lower and lower. And that means he's in a hurry to sell the stock. And so if you have an aggressive seller versus a neutral buyer, the greater chances are this would eventually break down, and a crack of support should be your exit strategy here. And the downside capacity would be the vertical distance that you see on your descending triangle. So extend that downwards and you have your target. The third type of triangle is what we call a symmetrical triangle. Symmetry meaning identical or happening in the same order fashion. In a symmetrical triangle, you will notice now that your demand line is actually going up and your supply line is actually going down. So resistance is going down and your support line is going up. And so again, eventually these two lines will meet, but you can see what's happening here. It contained the price and eventually it started to flail towards the lower end and eventually broke down. Now in a symmetrical triangle, just like a rectangle, this is normally very neutral, hard to say whether it's going to go up or down. But again, you will see what was the prior trend before this pattern began. And since that pattern was a decline, then I would assume that there's greater chances for this to continue with its decline. So 60% of patterns like this, if it comes from a decline, will continue to decline. And maybe a 40% chance it'll actually break up on top and turn itself around. The exit strategy, as soon as it breaks support, you sell and you wait. Your targets would be that the price would fall back down a distance equivalent to the height or the vertical distance you see here of the pattern. So we just keep doing the same thing over and over again. And whatever pattern we discuss, we just contain them in two lines. If it breaks over resistance, it's a buy. If it breaks below support, it's a sell. Another type of continuation pattern is what we call a rectangle. We covered this earlier. Here you have a flat support line, and here you have a flat resistance line. A breakout above tells you it's time to enter, and your upside target will be the vertical distance of this. Now, although these are usually continuation patterns because they continue the prior trend, it's quite possible to find this sometimes at tops. And so if this were to break below, then you would sell if this support line will break. Next pattern is called a bullish flag or a bullish pennant. Now, there is a bearish version of that, but let's start with the first. So a flag or a pennant is actually a temporary or short pause in price. These patterns only take maybe a few days to happen. They normally start with a strong trend move. They park maybe within a week or two, and then they explode into a really strong upward movement. Now, the measuring formula that we'll use when we gauge flags and pennants is a bit different than what we have here. Because instead of measuring the size from top to bottom of this body of this pattern, we will measure what is known as the pole of this particular pattern. Pole as in a flagpole. So if this were to be a flag, this is the pole of that flag, and the measuring form will be the high side of this pole to the lowest side of the pole, and that's what we're going to use to extend upwards here. So after that, you can see here it rockets up like with fury. Although the target was over here, it way past that particular target. And next, it stopped and it generated what is known as a pennant. So a flag is more likely like a small rectangular thing, whereas a pennant looks more like a triangle, but it only happens within from days to maybe a maximum of 1.5 to 2 weeks in total. So in this case, you have another small triangular formation. Prices broke out of that, and you will see prices leap up from that area. Just as we did before, your buy should be as soon as prices break over the range, and the measuring formula should be the height of the pole. In this case, the pole started from here all the way up here. So you can just imagine why this is going up quite quickly, because a lot of technicians who know how to trade this are jumping after the potential upside magnitude of this. Next, let's look at the opposite of this. This is what is known as a bearish flag or bearish pennant. The first one is a flag. This is also a flag, and this could be a potential pennant. So remember, if it looks more rectangular, it is a flag. If it is more triangular, it is a pennant. Okay? And again, it only lasts for maybe a couple of 1 or 2 weeks. After that, it breaches it, and from there you get a support crack, you sell, and you get an immediate decline. It builds a new consolidation pattern, a small rectangular movement, crack support again, and it heads off into a decline. The measuring formulas are, again, the pole of the flags or the pole of the pennants are what you use, and extend that from the breakout point to the next downside target. And please, of course, within reason. Because, for example, if you have an area pattern trading at 1 peso and it came from 2, and you have a 1 peso range, and it breaks down below a 1 peso support, that stock cannot go to 0. So it might go close to it, but it will not go to 0. So there has to be some degree of reason when you try to evaluate uses, especially into a downside. Now let's look at the second type of area pattern. Those patterns we looked at earlier are what we call continuation patterns because they continue the prior trend. These are called reversals because they reverse a trend. Let's start with the first, and this is one of the more popular ones, a double top formation. Now a double top would look like this. An uptrend going to a very nice strong move, first correction, rebounds, hits the previous high, maybe could pass it slightly or maybe just under it a little bit, and then falls back down more rapidly. And then you see it break the prior level of support. This confirms that you've seen a double top. Now, in a double top condition, you will only see this in tops, as the name suggests. But you will see the opposite of this at the bottom of a chart called a double bottom. Now, let me try to explain to you the need for this. Remember, I told you in the prior seminar we did was that trends change course gradually. And from an uptrend, they will go sideways first before going down. And this is the reason that an upward move after its first correction will try to come closer to the previous high to test that area of resistance and see if it's really still there. And if it is, and then it backs off more substantially because now the whole market knows there is a big seller there and they're withdrawing from that market much more forcefully. And that's what can generate an opposite force that changes the trend condition from sideways to down. So the selling condition here can happen in 2 ways. If you can see that the first top fails to secure into a new high, you can use that as a temporary profit-taking area. That means when I say profit-taking, you don't have to sell everything. That means you can sell a portion of your position. But if support is broken, you must unload all because now your downside has just been magnified. And because of that increased risk, you want to be able to make sure that you contain that risk from you getting hit. Another type of reversal pattern is known as a rounding top. Rounding top because you will see it's a really gradual sway from an upward through to a sideways one. Eventually it curves downward and eventually accelerates into a decline. You don't see this all the time, but it happens. And normally when it happens, the effect of this is very, very clear, and it's probably right 90% of the time. And so these rounding tops or rounding bottoms, the opposite of this, may be good clues to us because it gradually gives you that information. It gives you time to prepare for it. And so it's very hard. The lower end of that could also be support levels like this. If cracked, then you exit from that particular point. And finally, there is another type of reversal pattern that's been very popular to technicians, although I'm sorry, it doesn't happen too often nowadays. But a lot of technicians love to be able to identify one, and many identify them wrongly. And let's talk about what it looks like. So a head and shoulders pattern looks something like this. So if you were to look at me, you can see my shoulders are lower than my head. So what will happen is that your first high will be here, followed by a higher high, and then followed by a lower high again. And so if you look at this situation here, here's the first shoulder, followed by a higher high, the head, and then it falls back down to a support line, rebounds again, and makes again another lower shoulder on this. After the right shoulder is demonstrated, you will likely see it already for yourself that a high comes into a lower high, and you and I know that that is the definition or the beginning definition of a downtrend. And so this is also similar to this, a gradual turnaround from trend, and the measuring formula of this would be the height from what is called the neckline, the support line you see down here, neckline, all the way up to the head area, the top of the head area. So we will now measure the top to this neckline point, and this we will extend from the breakdown zone to command a potential downside target in price. So when you see a head and shoulder, it can really take a wallop in price, especially if you see them on top. If you see them on the bottom, it might be a good situation that upon the right shoulder of a head and shoulders reversal, which you find in bottoms, to be able to buy into the right shoulder because a potentially big reversal pattern is getting in, and that could be a big money-making opportunity for you. And the last patterns I'd like to discuss, these could fall either way. They could sometimes be continuation patterns, which continue a trend. They could be reversals. So we will just look at them because it can happen on two sides. The first is what we call a wedge. We have what's known as a rising wedge and a falling wedge. Now, normally a wedge is a continuation pattern. But in modern day trading, we've noticed that certain wedges, such as this one, happen after a decline. So you can see it falls down first, makes the wedge. A wedge looks like a triangle. The only difference between a wedge and a triangle is that in a wedge, you will notice that the two lines, your demand and supply lines, are pointed in the same direction. Whereas in a triangle, one of those lines are not the same. One is flat or one is up, the other is down. Never will a triangle show you two lines pointing in the same direction. If you see a situation like that, it's more likely a wedge that's being developed. And normally, as a general sense, whichever way the wedge points at, it intends to go the opposite way. So for example, if you see this, what is known as a rising wedge, line pointing up, line pointing up. So if that wedge is pointing up, that tells you the potential trend is to go down. And you can see what happens here afterwards. This is a particular worry for us because our market today, in a rebound that we've been seeing, it seems to be making something like a rising wedge. So we have to be a little careful that a potential pullback in the market can happen. So you can see I'm using a pattern that I've seen before, and I'm using that to describe what we're looking at into our market to help make a judgment call. And now I'm a bit more ready to be able to face that in case that situation happens. So in a falling wedge, the two lines are pointing downwards, and that's telling me eventually this is going to go up. And so a breakout is what I'm waiting for to be able to make an entry, and it did so. And the measuring formula, just like a triangle, would be the top end to the lower end of the range. In this case, it's the top end to the lower end of the range. Project it upwards in a falling wedge, project it downwards in a rising wedge. The other type of pattern that's also quite interesting, and relatively modern day patterns also appearing to this, is what we know as a cup and handle. Long time ago, I would only find this on the bottom of charts, but nowadays I would find them as a continuation in the middle of the chart, sometimes right coming off a major bottom, because it generally makes a combination of like a rounding bottom, and then it fishes out a pattern here, and then breaks free, and then makes a fantastic upward move in price. The nice thing about it takes time to build, so it cannot surprise you. So it's very clear when these patterns take place. First, it looks like a rounding bottom or a saucer, and then you will see like a handle come out of it. That's why this is the cup, and this is the handle of your cup. And in that handle, you have to get prepared to be able to buy this, because this can make a very, very strong move. The upside configuration would be the low end of the cup to the upper end of that cup, and you just project it upwards inside. Again, any breakout is a buy, so you buy it here and you wait for your projected target. Finally, we have what is known as a reactive channel. I think I pointed this out to you last time in our last seminar, but since it's also technically a ranged pattern, we'll also talk about how to use it. So remember, in a reactive channel, ideally you should be looking to sell or buy this on the low, buy on the low side, sell on the upside. But if the trend is downtrending, you should really just be using this rally as an opportunity to sell and to stay out of the market until this trend changes its course. If this is an uptrending channel, then you should just be concentrating on buying every support bounce you can and taking a little bit of profit when you see the high boundary or when it hits that price channel high, and then buy it back whenever the stock price rebounds off the support low. So again, different patterns, you can have a little different technique, but remember, even in a downward channel like this, if you get a break above resistance or break above this area here, it is also a potential buy, but please make sure that your support levels are near to your resistance rather than too far away, because it might make your risk condition too far. So the way I would rather do this is, if this is a potential breakout condition in a reactive channel, what I would want it to do is either move up towards resistance, wind up here first before breaking out, and that might spell a good setup entry for you, rather than rallying from the ultimate base, breaking out, and then having to stomach a temporary correction because it's too overbought and waiting for your entry there. So just be careful about that. Do not chase prices, okay? Even in a breakout situation. All right, let's have a demo of how to be able to spot this and what do I do in a pattern in terms of look at them in our charts. So let's run through this demo. So I have here a chart of AGI. Now, I chose this because it went through 3 trends, up, sideways, down. And now let's try to figure out where these patterns will be. So just offhand, look at where these little patterns be. You'll see up and down movements, draw 2 lines, and after you draw the 2 lines, and then you call it out. So you have a rectangle. Then it breaks out from that, goes up, and then eventually makes a correction. And then you can see up here, it creates a new consolidation. Let's just draw that out. Again, flat top, flat bottom, another rectangular range. This one broke down, rather broke out topside. Then it started falling back down again. And then after falling down tremendously, it became oversold and it built a new pattern. So let's draw our 2 lines. So if you notice here, the flat line is your demand line and the selling line is going down. So that's a descending triangle. And eventually it broke down. So these breakdown conditions that you see from these 3 areas here are really what we want to look at in a stock price. It offers quite a degree of help because it gives us preparatory conditions. I know what's about to happen. It could either break down or break out. If I can see that it's challenging resistance, then my situation as a trader is to get ready to be able to buy this. If it looks like it's getting ready to break down, I should start becoming more defensive. And the minute that support breaks, I'm out of there because it could change the trend and cast off a very, very big decline. So if you notice what happened in this end, it was quite a nasty decline. And you might say enough is enough, and that's probably why it parked here for a while and created a new pattern. But the descending triangle here is telling me that the seller is still very strong and the buyer is just very neutral, and that this could still go down. And sure enough, that's exactly what happened. So use area patterns as a ability for you to get a good sense of range. If it's big enough for you to trade, then you can buy and sell within the range. But the minute you see a new trend or a trend erupt from it, then follow it through a breakout condition or a breakdown condition. Now, here's another type of pattern I want to talk about. I completely isolated this because this is different entirely. This is known as a price gap. Technically, it's not really a pattern, but we still study this under patterns because it's a certain thing that we want to look for, and this formation can be very useful sometimes. Now, what is a gap? So a gap is simply a movement of price that goes way much over the previous day's entire range of prices. So for example, let's look at this area right here in the bottom. You can see that it was consolidating at this area here. And all of a sudden, after trading at this area, in the very next day, you see prices just jump up. And this space in between is what we call a price gap. Now, the very first one in a trend that you normally see, the first gap you see in a trend, is usually what is known as a breakaway gap. Now, it's called a breakaway gap because it breaks away from that prior trend or consolidation, and it's the first clue you have that something has changed. And it erupts in fury normally because perhaps some news came out that could help change the situation in the company. And that breakaway gap just tells you that something has changed, this stock is going up, and the mere fact that the price does not close that hole or does not close the gap tells you there's an underlyingly new demand level that has been generated, and this thing may have some time to go. After that, you can see it climbs up, winds up, and eventually another gap is generated. Normally, a second gap in a trend swing is what we call a runaway gap. Now, runaway gap is also known as a measuring gap because it appears right mid-center of the trend move. So we call it a measuring gap because if we see it as a second condition, it's usually at the middle of the trend move. And so that tells me there's still halfway distance to go. And so runaway gaps are usually favorites on traders of attacking this with fury. And in here, you can see why it went up very, very quickly. Here, it wasn't that quick because a lot of people had time to accumulate beforehand, and it parked right away because those people who bought here were taking some profits at this area. But here, a lot more bullish people have been generated. There are a lot of people have been making money. They probably all know the story in the stock by now, and everybody wants to become a participant. And given that, it skyrockets. Finally, it temporarily paused for a while. Perhaps it could make a little pennant or flag here, and then boom, you just see the stock price move up again. And towards the end of the move, a third gap is generated. And this is what we call an exhaustion gap. Now, we call it an exhaustion gap because it's the final gap that is generated. And second thing, that gap is usually closed right away. When we say close, you will see a correction that will close the hole in a matter of days. Whereas here, it did close until some time. Here, you would ever hardly see that gap closed. So the minute that exhaustion gap is closed, that tells you everybody who wanted to buy that more likely bought it already, and the buying has exhausted itself. That's why we call it an exhaustion gap. And that exhaustion is an exhaustion of the entire trend. And it could generate a reversal condition out of that. And you have to be careful, especially if you have crazy gaps like that, especially big ones, that all of a sudden within a day or two, you see them closing that hole. That tells you a lot of people who bought this are in trouble, and that could create an avalanche of selling moving forward. So you want to be also take note that these holes, they also act as new levels of support and resistance. So if this case here, if this had made a correction, you would have stopped right over that hole. In this case here, if that made a correction like this, it would normally not close. So the closer they get to these holes, you would get a supportive nature into that. Now, if you're in a downtrend and you have a gap down, a rally in a declining trend will have those gaps act as resistance. So try to be able to understand how to be able to take use of that as well. All right, let's try to be able to put what we've learned down into context in terms of corrections and area patterns. And let's start with this chart of SM prime. Now, let's begin with the first part of this. So eventually, you see SM prime moving up as a basic trend condition. Again, it's up and down. Now, let's start with the first. So it first locks itself into a new area pattern here. Can you try to figure out what this area pattern is? If you can see, support is flat, resistance is flat. You remember what that is called? Okay, good. That's called a rectangle. So now as you see the rectangle move, you can see what happens right here. But right before this breakout situation will take place, I want you guys to take note of what happened to volume. So volume is this picture you see here in the bottom of the graph, normally drawn as vertical lines. Now, these particular vertical lines are drawn directly under the date trade that you see that happens. So for example, this red line here happens to be on this day over here. As an area pattern progresses and that winding continues, as an area pattern goes sideways, volume should go down. And the reason for that is, remember I told you, in an area pattern, that stock is regaining energy. What's actually happening in an area pattern is you have the buyer and seller in there, either buying and selling from each other and eventually wiping the other one out. We don't know yet if it's the buyer or seller. But eventually, because one force is wiping out the other one, there will be no more shares to be traded within that zone in due time. And that's the reason that volume levels go down. And that's a tip for you, because as volume levels go down and they narrow, the narrower they get, the closer to the end point of a pattern it comes. And so as narrowing volume comes in, it could also warn you that a potential breakout is about to happen, especially if those volumes have gone down way back than normal. So in a case like this, you will see here, quiet before the storm. The volume levels are getting quiet before what storm? Before this storm, before the breakout actually happened. Now look, a breakout day can then, you can see what happened right after that. So normally in that breakout condition, you want to start buying your position. And if it pulls back to you to what used to be resistance or support now, you can also buy that back. And one of the things that we want to do is look at volume during that breakout period, or somewhere a couple of days, either right before or right after. What we want to see is evidence that the market believes in what you're doing and that this market is going to go higher. Here we saw an explosion in volume happen on that breakout day, and that's a good signal, because as volume expands along that breakout, it tells you that if you are buying that stock, you're not the only one buying, and that other people are coming along with you, and that pack of people are going to eventually push the stock higher. Can you imagine if you were the one who broke a stock price out and you were the only buyer in that breakout day? What happened? More likely the day after or the next day, you probably see prices come whipping back right away because they had no following inside. And so it's important to have volume confirm that breakout move. Now, the tricky part is it may happen on the breakout day. It might happen 1 or 2 days after. And so those people who want the volume to come in on the breakout day sometimes can get disappointed. My tack is, if you see a breakout, follow it unless the volume is just incredibly low. Now, if the volume is still not so strong on the breakout day, control what you buy. If you see on day 2 and day 3 that the volume comes in, then you can add into your buying because it's now confirming to you that demand is with you. Okay? Now, as the breakout happens, you come around, measure your size. Here comes an up move, and now you see a new pattern is built. Now, we'll talk about the measuring formula of these patterns in a little while, but now see what happens here. After it moves back up, it pulls back into your trend line, as it should, tries to rally again, fails to climb, pulls back to your trend line again. Again, it's trying to rewind itself to gain that energy. Remember the toy, you're winding it up all over again. And as you wind it up, and a pattern is actually framing itself, now we have to ask our question, does this have better chance of going up or going down? First, let's look at our trend line. Our trend line tells us this stock's going up. So that puts one positive effect into an upward move, continuing. Second, let's look at the shape of the pattern. We have a flat top and we have a rising bottom. Remember this? This is called an ascending triangle. So in ascending triangle, you have a neutral seller and you have an aggressive buyer. So that alone should tell you 85% of the time you see a pattern like this, it will generate an upward move. And sure enough, as you see what happened here, a new breakout took place and stock prices attempted to move back all over again. Let's go back into that previous pattern. So your pattern here, again, let's look at volume. As this is going sideways, look at your volume. It's actually heading downwards. And please, right before the breakout condition, look what happened to volume here. In this small 3-day pattern that you see right here, volume levels went down incredibly low. So what happened is the seller had nothing to sell anymore. The buyer has been looking for shares, but he couldn't buy anything anymore. So the buyer had no more choice. In order for them to fulfill the order to buy this, he had to look for the price upwards in order for the shares to come out. And this is the reason why eventually this stock broke out, gave you an opportunity to buy it, and then you see prices moving upwards. All right. Now, let's do a little math along with this because we want to put a little bit more of science in terms of projecting what will my target be in a breakout. So let's look at our first rectangular pattern over here. Now, let's look at the size, the vertical distance from the top to the bottom of this range. The height of this pattern was actually at price at 23 pesos and 20 cents. That's this high you see here. The low part of the pattern was at 18 pesos and 80 cents. So if you subtract 2320 to 1880, that comes out to the sum of 4 pesos and 40 centavos. This is the height of the pattern. Now, the height of the pattern, let's add that now to the breakout price. The breakout price here was the high, which is 2320. So 2320 plus 440, that tells me that this should go up by a minimum of 440, which would mean 27 pesos and 60 cents as a target. And if you had bought this on your breakout price of this range or a couple of cents above it, then your target should be 27.60. That should be somewhere over here. And you can see that easily the stock hit your target after making that assessment. Let's look into the second pattern. Here we have an ascending triangle. Let's measure the height. The height, the flat top here was at 31 pesos. The low side of the range was at roughly 25 pesos and 30 cents. So let's get the height. 31 minus 25.30, that's 5 pesos and 70 cents. The breakout price, which is this price here, the price that this went above resistance, was at 31 pesos, which is the high. So 31 plus 570, potential target, 36 pesos and 70 cents. And if you can see what happened here, it stopped at 35, but went all the way up to a high of 37.50. Eventually, this even went up to 40. So in looking at these area patterns, it can help you make an assessment. If you had this stock, you could have just held it. If you didn't have it, you could have just bought it on the breakout price, save yourself so much waiting time here, unsure of what's about to happen, or even here, and only put your money when it counts, when it's about to move, and then experience that profit-taking maneuver in a relatively short period of time. And that's where technical analysis attempts to be able to help you, in essence, that gauge of timing. Let's have another pattern here. Now, I'm using this because I've noticed a lot of people have been trading this stock every once in so often because of potential for a third telco effect coming into this. During that time, coming towards 2018, let's have a look at what happened in this stock. There was a very, very long area pattern. Remember, I told you, an area pattern, we will also look at the length in time. In this case, it did that consolidation for a really long time, months. And that means the potential upside that this guy was suggesting was incredible because it did such a long wind. There should be enough potential energy to be able to push this up quite well. If you want to get a sense of what that's like, I want you to imagine that you have a soft drink bottle with you. And here you are, you're holding that bottle in your hand, and you're now shaking that bottle up and down, up and down. And if you notice, the bottle cap in there is still quite firmly closed. But the more you shake that bottle up and down, inside that bottle you create pressure. As the atoms, of course, get more excited, the oxygen levels, the carbonated oxygen starts to be able to try to free itself, but it cannot because the lid is on it. But inside that bottle, you get enough generated force. So can you imagine if you just shake and shake and shake and shake that? That's exactly what's happening here, where this pattern's winding up for such a long time. The minute you release that cap, boom, you have an explosion in price come in. And this is the reason that the stock moves from 1 peso and almost goes to 2, goes to 3 pesos in almost a bat of an eye. And so a breakout price, if you had bought it, would have reaped benefits to you relatively quickly right away. Also, if you look at the volume levels during the breakout time, volume is quite substantial. So that gave you the confirmation you needed that this breakout should be trusted. And it could be that rumors about this company eventually participating in being a third telco is actually coming to place. Although the details may have still been sketchy at the time, but rumor enough managed to be able to push it and liberate it from that big area pattern. After that, a new pattern was generated after this good volume. And you can see it flattened to like a horizontal pattern here, and eventually it broke out too. And after that, it just leapt also with very strong fury. Look at the volume, incredibly, incredibly large. Now, let me just warn you, however, a very huge amount of volume in a stock may not be necessarily good. And the reason for that, that means every Tom, Dick, and Harry may have bought that company already. And so look what happens after that. After an explosive move, this stock went from almost 380 all the way up to 8 pesos per share or a little over. And after that, it has never climbed back up there and again. It spent a great deal of its time building a new area pattern. Can you try to guess what this area pattern is? It has a flat base, and you can see that its trend line up here is decelerating or going downwards. Remember what it's called? Right, it's a descending triangle. So now you have a seller who tells you he's trying to get out, some buyers trying to be able to buy, but only at this price, and eventually, look what happened. Over time, volume levels started going lower and lower until there was no more volume at all. So try to imagine the situation. You've got a lot of shares caught up between 5 pesos and 8 pesos per share. Now, there's no more demand to buy that stock. Volumes are very thin, and you're stuck in there, and you've been in there almost a year. And so it creates a heaviness in pressure, and is the reason that this descending triangle should have forewarned you that the impact of this should be a downside impact. And you might ask, by how much? Well, let's do our basic calculation again. So let's measure the height of the area pattern to the base of the area pattern. Height 860, low end 480. Size 3 pesos and 80 centavos. Where is the breakdown point? The breakdown point would be the break of this shelf. Also, you would notice I drew a trend line here, and you would clearly see where the breakdown condition is, right here below the trend line. So now, let's get this measuring formula, and let's now measure it on the downside here. So where is the breakdown price? Support was at 480. So 480 was a breakdown price. Let's remove 3 pesos and 80 cents from that, and it's telling me my downside target is 1 peso. You're saying, what? 480 to 1 peso? Are you kidding? Well, many people were telling me exactly that during that time. And please look at where the price had fallen to. So after that, you have a new downtrend line being created. We're still in that downtrend right now. However, after this major decline has taken place, volume levels are starting to pick up, which is a good sign. And hopefully this exceeded amount of volume should try to be able to pick up a worthy rally into this. I really hope that this can try to rally all the way back up there. But remember, you are in a downtrend. In a downtrend, we're just supposed to use the rally as an opportunity to get out. Because right now, there is no reversal in this yet. It's still a downtrend, but it's oversold. And so this rally should be used as an opportunity to lighten or take that position off. Not to involve a new position unless, of course, you'd like to be a daredevil and try to buy it here in projection of a target maybe between 2 and 2 pesos and 50 cents. If you do that, just make sure you have your crash helmet on. All right, so let's put the summary of what we talked about so far. So we managed to be able to understand what a correction is. So a correction is a necessary pullback in price. It's a way for prices to fix this extendedness that it has. Because when prices get excited, they go to what is known as an overbought and oversold condition. Overbought meaning an upward stock climbing too fast too soon. Oversold meaning a stock that's falling down that's also fallen down too much too soon. It allows or it begs for a correction to come in to interrupt that overbought or oversold condition. So in an overbought condition, corrections will allow the price to either go down or go sideways. In a decline, a correction will allow the price to either rally upwards to the resistance or go sideways also. Now, a sideways type of correction is known as an area pattern. And an area pattern will come around to ask us to look at few things. One, the shape and the size. The shape or the geometrical shape will tell us what to expect. Is the buyer gaining strength against the seller? The size will tell us the potential range it will be or the length of the time. And that should be able to command how much force this should be able to present itself after a breakout or a breakdown takes place. Now, continuations or reversals. Well, we would like to be able to categorize area patterns so that we know what to expect. If we do see a continuation type of pattern come in, then we know that whatever the prior trend was, more likely it will continue thereafter. If, for example, you see an uptrend and you see a potential head and shoulder start to fix, and you know those things only appear in tops, then you know that I should be raising my defense, because potentially this could reverse that uptrend and eventually turn it down after a sideways maneuver completes itself. Also, if you see a decline and you see a rounding bottom take place or a cup and handle show up, then that could tell you that potentially that could turn itself around, and you should be prepared already to be able to buy more of that stock as soon as the breakouts or the resistance breaks are taking place. Then, measuring the moves. We check to see what the height of the pattern is so that we can try to project what our targets will be. It is helpful. Why would I buy a stock, let's say, for example, at 10 pesos, if the upside it's projecting is only from 10 to 10 pesos and 30 cents? That's nothing. And that's not substantially enough to cover for commission charges. So if the target site tells you, okay, my breakout is at 10 and projecting at 13 pesos, then that shows you a substantial amount of upside that it enables. And then you can now say, all right, I'm going after this stock because it's worthwhile my time. And finally, we want to be able to use or confirm the movements of these prices along with volume, because volume is the third dimension of price. I want to know if the market is going in my favor or not believing what we see. It can also prove helpful that if you're seeing a pattern that you suspect to be bullish, that once that bullish move is starting to begin and the volume comes along with it, you do have the backing of the crowd to be able to get this where you want to go. If you're buying a stock and you're the only buyer and there's hardly anybody moving in there, that lack of volume could be a very big problem. You see, it's quite possible that the breakout could be instigated by somebody out there trying to fake a breakout. And if that individual was the only buyer in town and the volume show it because it's very tiny, then you can, like I said, just control what you buy to make sure that you are not gulped in by what this guy is trying to show you. So in today's topic, we talked about what is corrections and what area patterns can prove to be very useful in our ability to trade. And you have to be able to engender your ability to practice this as times move on. And you might find it a little difficult to spot patterns in the beginning, and of course, even maybe to draw trend lines. But as you do this over in time, and you practice it, and you draw it, and you look at examples, and you review this video, you'll get a sense of how to do this on your own. And as you come around to master these things, you will see how your timing into these patterns become very, very much more heightened. And next, when you start looking at price charts, you're going to be seeing these things very quickly and automatically. And hopefully one day, when you look at a stock chart, it will take you only maybe 1 or 2 seconds to look at a single picture and know exactly what to do, because you have all these guidelines working in your favor. All right, so I hope you're still with me, and if you, for those who are, good job. You've managed to be able to see what the second chapter of technical analysis is all about, and now you understand why this market goes in zigzag motions. Those corrections are necessities for us, and we should look at the opportunities that they come out to bring. So in our next episode, that will be on next Friday on the 22nd, we will talk about technical indicators. We will try to check why we need them, we'll see how to use them, and we'll give you a demonstration of 3 types of indicators to help you get a feel of what these indicators are like. There are much more than that, but once you learn these 3, you get a picture of what they do, when to use them and when not to use them, and how to be able to complement the use of trend lines, your support resistance, your area patterns, and blend them together in a very unified system in your trading. And after that, we'll talk about building the trading plan, where we'll use everything that we learned in the next 3 sessions and try to be able to put forward towards you the fullness of what the trading plan is like, and so that after that, you can look at any stock, any currency, any commodity, use this and take advantage of any formation and any timely situation, and use that for your trading expertise to make sure that you can increase your amount of profitability and contain any risk that you take from them. So with that, I bid you good luck, and I hope that you manage to learn a lot more from today's session.